if you're looking to buy a Hyliion stock, then please keep watching because we're going to look at the company's recent performance, how the market's treating it, and what are the technicals telling us. We're also trying to come up with the best trading approach given the circumstances. As the market remains volatile at the moment, we should always be mindful of which positions to pick, as well as their individual timing and exposure. Before the video begins, if you would like to see more stock analysis videos like this one, please remember to like, comment, and to subscribe to my channel. Recently, there has been a major change in Hyliion's strategy going forward. The company decided to pause their efforts in developing ERX-equipped trucks and new powertrains. In other words, instead of coming up with new powertrains, they want to focus on the generators and add-on products for fleet companies to reduce their fuel expenses and carbon footprint without changing the truck in its entirety. While the change, at least to me, seems logical and sound on paper, the market took the news poorly and has decided to divest its capital in Hyliion in pursuit of other options. The logic behind this decision might be because the market believes that eventually the combustion engine vehicles are going to be replaced and how, like right now, Hyliion is simply servicing products that are going to be left behind. This assessment may or may not be true and accurate, but it is certainly what a very large portion of people believe in. So with that being said, let's take a look at the technicals of the stock. The trading volume of Hyliion has recently been around 622,000 shares versus the average volume of 1.3 million shares. Over the previous 52 weeks period, the price fluctuated between $1.15 and $3.88. The volume of shares traded tells us how many shares are being bought and sold at any given point, and if there's enough liquidity to support a trading strategy. If the flow remains thin, it would be very easy to influence the stock price, but the low liquidity could also mean that the demand is limited. As we compare the current volume against the average volume, there might be the possibility for trend reversal or breakthroughs. For instance, if the stock were to break through, the current volume would be significantly higher than the average volume. The market cap of Hyliion is currently around $216 million versus the enterprise value of $188 million. As we compare the current price to the historical price fluctuations, the stock is 7% higher than the 1-month low, 7% higher than the 3-month low, and 7% higher than the 52 weeks low. On the options market, which often gives a hint on the market sentiment about where the stock price is probably going to go next, the implied volatility is 53% versus a historical volatility of 60%. The put-call volume ratio is currently at around 0% because there is no put option. It is normal for many stocks to have a higher put option volume than what they deserve, as many institutional positions are hedged. The most recent volume of options traded has been 17 contracts a day versus the 30-day average of 327,000. In terms of open interest, the most recent volume of open interest has been 37,000 contracts versus the 30-day average of 37,000 contracts. In terms of the shareholder structures, institutional shareholders own 30% of the outstanding shares. The biggest shareholders include BlackRock, Vanguard, and iShares. It's always good to see some institutional participation when holding a stock long-term because it offers a layer of stability and a token of reliability in the medium to long term. It could mean that the market is confident that it will deliver value in the long term, but it can always mean that the market is just agnostic to whatever happens to it because their individual exposure is very low. I personally believe that a minimum threshold to be typically around 30% of institutional ownership, although there are many exceptions to this rule. For instance, Hyliion currently has around 30% of institutional participation. I wouldn't say that I'm very comfortable in putting my money, in trusting my capital to this company, given the current circumstances. This is like one of the exceptions when it comes to choosing between trading and investing. The current short interest is around 9% of the total float, and 45% of the transactions are coming out from the dark pools. Usually, if the short interest is above 15% of the total volume and a significant portion of the short volume coming out from the dark pools, it may suggest that there are institutional positions taken to short the stock and there would be potentials for a short squeeze. So, right now, the global markets are facing a complex interplay of factors that have the potential to significantly influence the equities worldwide. In this speculative analysis, I believe that the consequences of the global inflation, surging commodity prices, and decline quantitative easing, as well as the rise of inflation rates or interest rates, plus the geopolitical instabilities, are going to play a significant part. The increasing inflation rate has been putting pressures across the globe, threatening the purchasing power, raising the input costs, and impacting corporate profitability. Companies operating internationally may face challenges in managing rising production costs and also to sustain profit margins. Those dynamics could trigger market volatility as investors adjust their risk-return expectations. The upward trajectory of commodity prices, including energy, metals, agricultural products, have been having far-reaching implications for various sectors of the global equities market. The companies heavily dependent on these commodities may experience squeezed profit margins, potentially affecting stock valuations and investor sentiment. The reduction or the end of QE's quantitative easing measures by the central banks worldwide may have resulted in reduced market liquidity. So this in turn could lead to higher borrowing costs for companies seeking capital, which may also discourage investment activities or will. The elevated market volatility plus the reduced investors' appetite may also continue to occur. Now, the central banks around the world are tackling this delicate situation of balancing the inflation rates with the economic stability and, if possible, growth. Central banks opted for aggressive interest rate hikes to combat inflations. Borrowing costs for companies have been rising, which has also slowed down business activities and also fueling the market's volatility in terms of the equity prices. Now, ongoing geopolitical tensions, including trade disputes, political uncertainties, and social unrests, will inject an additional element of volatility into the global markets. Investors may adopt a cautious approach, shifting towards safer assets, impacting the equities. Additionally, the escalating conflicts may disrupt supply chains, negatively impacting the performance of international companies. Given the interconnectedness of global markets, the aforementioned factors have reverberating effects on the US equities market. Companies with significant exposure to international market may face a lot of headwinds resulting from the economic slowdowns, disrupting the supply chains and the currency fluctuations. But nevertheless, the US market is known for its resilience, and the diverse sectors may attract investors seeking safe havens. So really, the current landscape is characterized by global inflation, surging commodity prices, reduced quantitative easing, rising central bank inflation rates, geopolitical instabilities, and also ongoing lack of certainty regarding growth. While the US market may exhibit relative strength due to the safe haven status, it's going to remain interconnected with the global economic landscape. For long-term investors, these conditions may offer opportunities to identify undervalued companies with strong fundamentals and international diversification. With that being said, short-term trades should be approached with caution because of the increased volatility and uncertainty. And also, we should be careful when assessing individual companies, sectors, or regions instead of choosing ETFs. My recommendation for Hyliion is to stay away from the stock for the time being and to look for when the stock manages to stabilize its price before going back, if ever. Hyliion has been mostly bearish for the past few years, and this trend isn't showing any sign of stopping.